Hi everybody, Joe Conroy, your financial advisor, and I've gotten some feedback on the videos. They seem to be helping at least some people, so that's a win, and I'll keep making them if they're going to help kind of add some perspective. There's a lot of noise out there. So if I can offer some clarity and maybe a little confidence with your portfolios and your plan, then I'm more than happy. I cannot answer questions that I don't know what those questions are. So please, if you have any questions or if anything's changed since our last conversation, give me a call, give me an email. And I'm still in the office. I'm here for you. And if I can help, get through this market cycle any way that I can do that, I'm here to help. If that's a video or a phone call or everything in between. So let's get into it. Today I want to talk a little bit about the emotions of investing, and there's a lot of emotions right now with investing, so we're going to cover that. I'm going to tell you why I really, really don't like market timing, how I don't think it helps people achieve their financial goals. I'll tell you why. And I'm going to talk about retirement planning, more specifically the planning that we do here at Hartford Retirement Planners. A lot of you have seen it, maybe some of you weren't aware of it or didn't have an interest up until this point, but I'll show you what that looks like. And that should be enough. So we'll get into the emotions. All right. There's really two emotions that drive maybe poor financial decision making when it comes to investing. The first one is greed. So believe it or not, there actually is a little bit of greed that I've seen. And it really shows in the form of trying to pick that really disenfranchised stock or sector right now. And everything is down for the most part. But in order to rebound and recover, you don't have to try and catch that falling knife completely. Is hospitality going to come back? The airlines, which specific airlines, which specific hotel companies? Those are answers that no one really knows. And the fact that those industries are beaten up more than others, there's a reason for it. There's a lot of smart people who are trading this market, and they think that they are at below market levels for a reason. And I'll give you, there's a very real example, and this drives a lot of my philosophies are driven by past experiences through clients I've worked with and other financial advisors. So I'll tell you a quick story about why greed can work against you in a rising market, because not everything does come back up if and when the market comes back up. So a client of another advisor in the old office was interested in a financial company in 2008. People were getting bailouts. We kind of seemed to be getting through some of the worst of it, and they thought that there was a financial company that was an institution, been around since 1850, prior to the Civil War. It was going to get a bailout, and the thing was a little bit oversold. That company was Lehman Brothers, and the amount of money invested was $40,000. The amount of money coming out of that investment was zero. That was a loss. That was a bet. So let's view those types of strategies. It's pure speculation. That's trying to predict the short-term future or the long-term future for specific companies. That's just so tough to do. There's a lot of factors at work. So I try to just encourage people that if you do want to do those things, that you don't put any money that you need for short-term or long-term goals at risk. And you definitely don't want to count that money as part of your overall retirement or financial plan. So just want to point that out. Fear. Fear is the other one. Fear is a very, very powerful, more powerful than greed, and it has ruined way more portfolios, at least in my anecdotal experience, than any other type of factor. It's not the market drops that make me nervous. It's the fear of what investors think in the market at that time. FDR said, we have nothing to fear but fear itself. Well, as a financial advisor, I don't really think we have anything to fear but clients' fear. Because if we're invested appropriately before this, in the middle of this, eventually after this, I think we'll still be invested appropriately. And we're positioned for a rebound. Now we just have to be patient. And if fear grips us before the patience sees itself through, that's a problem. Why are we fearful? There's two different types of fear that I have found. I'm overgeneralizing a little bit, but they kind of fit two categories. The first one is the risk that everything is going to go to zero. People say, I just don't want to lose all my money. I don't want to lose all my money. I get it. I don't want you to lose all your money either. And here's why I don't think that's a possibility, that I should say a high probability. I mentioned before a stock intersection report. I am still offering that, but I'm just going to go through one that I did for a client. I'm going to rattle off some of these names. So these are stocks that this individual owns inside the mutual funds that we're invested in. Microsoft, Amazon, Comcast, Facebook, Visa, United Health Group, Apple, Johnson & Johnson, Google, Adobe, Cigna, Pfizer, Citigroup, Honeywell, Wells Fargo, Disney, on and on and on and on. All right, going to zero means that Pfizer, Disney, Microsoft, Apple, they're all out of business. Nobody's working there, no more iPhones, no more any of that stuff. It's all gone, all right? Now, what we have learned through this pandemic is that the currency of the future is toilet paper, all right? So instead of worrying about selling out of the market, you should sell out of the market if you think things could potentially go all the way to zero. This is tongue-in-cheek, all right? Sell out of the market and stock up on the toilet paper, the bullets, and the bottled water, because that is going to be what you'll need if everything does go to zero. That means there's a foreign power that's overtaken the United States, and the way of life as we know it is completely gone forever and not coming back, all right? So that's what zero looks like. Now, if anybody thinks that that's the case, give me a call. I don't think anyone watching this video really thinks that the entire economy is going to collapse forever and that all these businesses are going out. All right, so then there's the second, and this is probably a little bit more dangerous because it's a little bit easier to rationalize, and it's the, I just don't want to lose any more money. Now again, we own those stocks that I just mentioned, or at least this individual, and anyone watching that's invested with me is probably somewhere similar. You know, could any one specific company drop and never recover or go out of business? Yes, but that's why we have so many different types of stocks and different types of investments in a diversified portfolio. I don't want to lose anymore. So then the next is, look, Joe, let's, I haven't heard a lot of this. In fact, almost none of it. But in the past, Joe, let's get out and get back in when it's better. All right? That sounds good on the surface. But when we start to ask questions and drill into specifics, it's just unraveling. Get better how? Better as in we feel better about the things are calming down and we kind of see where the end of this current event is? Because the market's already going to be higher when that happens. You know, the market is forward thinking. It doesn't look at things in the rearview mirror like most people do. It's anticipating what's coming next. So if everything looks good coming up, we feel better, but the market's already up. So if we sell out and buy back in, we've just sold low and bought high. And that is the exact opposite of what I want to do for my clients. I don't want to sell at low prices and buy again at higher prices. Then everyone's beating me up over bad performance and kicking themselves if they did it themselves, if you're a do-it-yourself investor. So that's not a good strategy. So better really means when things feel worse. So if we're selling out now, we're going to buy back in at lower prices. That should hopefully be the mindset. And I'm going to tell you why that's next to impossible, if not impossible. Last week, I'm filming this on a Monday. It looks like the market's going to be up. The market's been down every Monday for as long as I can remember, so that's a little bit of a surprise. Last week, we had unemployment numbers. Over 3 million filing for unemployment, a number we haven't seen before. It was incredible, and it beat all the estimates worse, right? More unemployment than we anticipated. What did the market do? It went up 5% that day. Defying all logic, right, and reason. And in the short term, with this much volatility, it's very tough to kind of make sense of some of these things. And very humbling for day traders if you're silly enough to try that endeavor. So anyway, back on track. So I'm going to draw on the whiteboard. Just because we're not able to meet in the office face-to-face, I still have to subject clients to the whiteboard. Purely for illustrative purposes. All right, let's say that we have a portfolio and we've hit a rough patch here. And we say, Joe, we're going to sell out now and we're going to buy back in when things are, quote, better, meaning lower prices when everybody's even more scared than they are right now. That's unlikely, but let's just go down that path. We're going to set a target. We're going to say if things drop 10% more, I'm going to put my money back in the market. Well, hey, you just saved yourself 10% drop, right? Yeah. If the market actually drops 10% or whatever the metrics is, again, this is just an example for illustration. Let's say the market drops, and this is our negative 10% number, but it only drops 8%. So we have an 8% drop. it never touches this trigger point, and then it starts to bounce back up. What if it bounces back up higher than where we sold out? Now what? We've just done the sell low. Are we going to buy high, or are we going to wait it out? Well, maybe we say, okay, maybe 8% is that new floor. Let's wait till it gets back to that level, but it doesn't go down fully completely because there's other people trying to time this market unsuccessfully. It only goes back down to a net 6%. All right? Now, what's happening as we try and figure this out? Whatever emotions you felt leading up to selling out, you're going to feel those emotions trying to time getting back in. It is next to impossible. And every day, you're going to wake up as an investor and say, is today the day that I put all my cash back to work? Do I average it back in? What if I average it back in and I really just average the price that I sold out? All of that was for really nothing, right? A lot of extra work, no extra gain. Or what if we get to this negative 10%, but the reason that it's dropped 10% more is that everything is so much more scarier than when you sold out, you can't bring yourself to buy back into the market. And let's be honest with ourselves, right? That's a tough one. Things are worse. If I was panicked up here, I'm really freaking out down here. So waking up every single day to try and time the bottom of the market, I've never seen an investor do it successfully. Actually, I've got a whole portfolio of people that I can show you that have not done it and that they have lost hundreds of thousands, if not millions of dollars cumulatively trying to do this exercise. There's even some advisors who think that they can time the markets. And I can tell you firsthand, I've seen the statements of these advisors. None of them have been successful. So if you think that we're not going to zero, and that owning these high-quality blue-chip names will grow in the future, I certainly feel that way, then we don't need to do this timing game. All it's going to do is maybe shave off 5% of return over the lifetime of your investments, but it's going to introduce an entirely huge amount of risk that you don't get invested, you get invested at the wrong time, and you lose real money. My job as a financial advisor is to evaluate risk and reward. The risk of market timing does not come anywhere close to the potential reward of getting it right. If a 5% drop in the market, if you can't stomach that, then your overall financial plan is on shakier footing than it should be. So market timing, I don't know how else to say it. I do not recommend it. I'm very, very opposed to market timing. And I think it's just killed more portfolios and financial plans than most other risks that I've come across. All right, on to better things. Everybody's stuck at home for the most part. Hartford Retirement Planners. Believe it or not, we do retirement planning here. And that's not just me going on the whiteboard, that's a part of it. But we have really comprehensive and in-depth financial planning software. Comprehensive, in-depth, and very detailed for me. The output, simple for you. It'll give you a percentage of success. And then we can push some buttons and pull some levers to see how we can increase those numbers to really help you achieve your financial goals over the long term. And if I think you see where the path is between where you are right now in this down market and where the future might hold, I think it might help you feel more comfortable with the decisions as we kind of work through these turbulent times. All right, so what does it look like if you haven't gone through it before? If you have gone through it before, it's a good time. Let's refresh it, all right? If you haven't gone through it before, just give you a quick what you can expect. All right, so this pamphlet with these happy-looking dogs on here, right? That's the cover sheet. That doesn't really matter, but really what we have here is it's 2 pages, all right? So we've got 2 pages, relatively simple questions, where you tell me where you are and where you want to go. I've got a lot of the where you are questions if you're a client. I know where the accounts are, I know how they're positioned, I know your ages, I know a lot of that stuff. But maybe I don't know what your goals are for retirement. Maybe you don't know what your goals are for retirement. What does retirement look like? Do you want to retire in a traditional sense, or do you want to work because you want to, not because you have to? What does it look like for you? Those are discussions that I love having with people. That's why I've really focused on the retirement planning piece. Portfolios are super, super important, and that is the tool and the mechanism to help us achieve those goals. But the money is a tool. It's the goals and your personal outcomes that are so important to what we do here. So let's put it out there. And I've spent, there's a lot of communication I've had. So if you've gotten a beginning of the year email from me these last few years, I list all the different things I can do for people. If you're stuck at home, hey, let's go through some of those things right now. And retirement planning might be the most important piece to your puzzle that you haven't figured out yet. Let me do that for you. It's all included, so there's no extra cost if you're a client of going through your retirement plan. So I can tell you with some percentage certainty how well the path that you're on leads to success and what you can do to improve it. I'll give you a clear picture. Anyway, retirement plan. Please take me up on that. Please ask me any questions. I'm not a mind reader. I don't know if you've had any extra concerns since the last time we've talked or the last video that you've seen. I'm really enjoying the conversations. I think they're very helpful for clients. And if I can provide value to you, that's what I'm here for. I'm helping people as best as I can get through this so we get through on the other side and we don't make any major financial mistakes on our path to get there. So as always, thank you for the business, thank you for the trust, and thank you for watching.